All right, faith in the strat. It's going to be our risk management class, oily boys. So introduction, good afternoon, evening. Welcome to our presentation on risk management. As traders, we know that there are always risks involved in the markets, but risk management can help us to minimize these risks and improve our chances of succeeding. With this presentation, we're going to explore risk management and why it's important. Obviously, I mean, we all know it's important, but why? We're going to discuss different types of risks, such as market, credit, operational. We're going to explain the steps in the process, and we're also going to cover some common risk, management techniques, and we'll discuss different strategies for mitigating risk. All right, so throughout the presentation, we're going to provide examples of how traders can apply these risk management techniques to their own trading, and we'll highlight some best practices for effective risk management in trading. Also, we'll touch on some common mistakes that people make and how to avoid them. By the end of this presentation, you should have a better understanding of risk management in trading and how to apply these concepts to your own strategies. Let's get started. Who excited? All right. Understanding risk management. Oh, hold up real quick. Let me make sure y'all are muted too. My bad, y'all. Y'all be unmuting and trolling me and throwing my focus off. There we go. All right. So risk management, it's the process of identifying, assessing, and mitigating risk in order to protect capital and achieve trading goals. In trading, risk management is essential for preserving capital and avoiding losses, as well as for achieving consistent and profitable results over the long term. There are different types of risk in trading, each with its own characteristics and potential impact on trading outcomes. Here are some of the most common types. Market risk is just the general risk of losses. So, due to changes in market prices or conditions can be caused by factors such as volatility, liquidity, and macro events. So just think general market fluctuations. Credit risk, this one doesn't really apply. It's more general. We can skip this one. Operational risk. This is the risk of losses due to internal or external operation factors such as errors, fraud, or system errors. I kind of think of this more like sometimes like broker errors, like you get logged out, which people don't talk about. You get logged out, your broker can just glitch. You can get stuck in an order. It's rare, but those happen, which is why we can't just be fully exposed because shit like that does happen. Mental risk. I think this is one of the biggest ones. This is the risk from mental scarring from large losses. Who's ever had that? I know people have had that before. I have many times. Yep. So that's called trader PTSD, which we'll talk about how to get over that. Yep. 100%. Yep. So the risk management process. Effective risk management in trading involves a systematic approach, a disciplined approach, identifying, assessing, and mitigating risk. Here are the key steps involved in risk management to process and trading. So like most people, when they approach their trading, the main thing is they just don't have a plan. I've noticed they kind of just do whatever, and then they wonder why. But it's like, if you just do random shit, you're gonna get random results. So identifying risk. The first step in risk management is to identify the potential risk that can impact trading outcomes. This can be done through various methods, such as analyzing the market, conducting scenario analysis, or consulting with industry experts. Don't worry about that. That's more for, macro. But the main thing is understanding your risk to each per trade. So the easiest way, I like to do whatever trade I'm potentially analyzing, I'm looking at the downside. I'm already having a preset stop loss or amount I'm willing to lose per trade. Once the potential risks have been identified, the next step is to assess the likelihood and potential impact of each risk. This involves evaluating the probability of the risk occurring and the magnitude of the potential losses that could result. So this is going to go case by case. Each trade is going to have just different risks. If you're getting at open, you should know your main risk is to be the volatility. That you can get in like a minute or two, gap up, gap down. When you're trading midday, you need to know your main risk is really going to be getting stuck sideways and getting chopped up. So understanding each trade is going to have different types of risk and how to approach it. Just a second, y'all. All right. Developing mitigation strategies. So based on the risk assessment, traders can develop strategies to mitigate the identified risk. This can include implementing risk controls, stop losses, orders or position limits, or adjusting trading strategies to minimize exposure to certain risks. So for me, I'm like a person that likes to use stops, like either mental or hard. In general, I like a stop usually on my chart. And then I have like a 30% stop loss. I try and keep it like no matter what, my stop is 30%. But there are times where I'll have a stop on the chart and that'll get hit and I'll get out before my 30. So it's really going to depend on scenario, which after I'm going to show you guys what I mean by that. But the main thing is most of you guys just don't have stops. Like you don't limit. So when you take on a position, you guys have full exposure, and people don't understand like exposure works both ways. So you expose yourself to profit, but you expose yourself to risk. So if you're constantly just exposing yourself to risk and profit fully, you have a bad day. That's how you start to consistently lose money. Another thing, a lot of people, they just don't size consistently. So monitor and review risk management strategies. Risk management is an ongoing process, and traders should continually monitor and review their risk management strategies to ensure that they are effective in mitigating risk and achieving trading objectives. So this means constantly updating your trading plan. So like for me, I'm always in my head, like I want to take a 1 to 3, but people kind of get that confused, and they're like, okay, if I put up 100, I can, I need to make 300. So think like I could buy a contract for 100, make 300% return. But what they're not realizing is A, the 300% is going to be hard to get. And B, they don't have to risk that full 100. So when I say a 1 to 3, you can kind of get the same effect if you were to aim for just 100%, but use a 30% stop. That's why I like to use a 30, because I know any trade I go for, I'm aiming for at least, 100% return, which is very easy. So as long as I can keep it where I'm getting like 100% return, and my stops are on average about 30%, I'm usually at, a 3 to 1 or a 1 to 3 risk right there. So it's really understanding the amount you're putting up, but then how much of that is going to be exposed to actually getting lost. Because if you're going in with that stop, perfect example, if we go up to 200, but we use, instead of 30% off 100, we're using 15%. We're still risking the same amount. So understand it's really about your stop or your limit, how much you're going to limit price. So the risk management process can be applied to various forms of trading strategies and instruments. Here are some examples of this process and how it can be applied. In trading futures contracts, traders may use technical analysis to identify potential risks, such as price trends or volatility spikes. They can use stop loss orders or position limits to manage these. So for futures and options, especially options, this is where you have to understand, like, okay, if I'm gonna buy at certain, X, Y, Z price, but depending on the time of the day, if I sit sideways, I'm going to get eaten up by theta, which is going to cause, it's going to cause my stop to trigger a lot more likely. So perfect example would be any of these cheaper assets that we sometimes buy, like the 50, the 25-cent strikes. Most of those, they're so low and they move so little that the theta starts burning through them. So especially if you get down to like 10, you're instantly going to be at negative 50%. Like the smallest move. I don't know if you guys have seen that. Like that even happened to me on INTC last week. I was down 50% the moment I got into the trade. I don't know if you guys have ever experienced that on the cheaper options. I guess nobody's okay, perfect. I'm like, nobody. So the easiest way to prevent that, even me, I did it exactly. Yep. And it's not even just the spread. It's just that they have their value is so low. So like that, yep. So the way you guys can fix that or avoid that, yep, F1, don't buy anything with wide spreads, especially when we're not moving. In general, like that's just for me not a part of my plan. I always check the spread. If I get in something, the spread is off, even if it looks good, I'm gonna get out unless it's like flying. So like if you guys noticed, it was like 2 weeks ago, I caught out USO, and then I paused because the spreads were just way too wide. So, you know, if you're getting in something with a bid of 50 and an ask of 160, you're gonna get killed. That's why I don't like trading, you know, XSP, because you know, spreads are trash. So you're gonna get a false gain. But what you can do, especially like with INTC, you don't have to necessarily buy time, which is time is always good. But that trade with INTC, the only reason I didn't really care to do it was because I had very high conviction and I wanted to go cheaper to get more contracts. But realistically, let's say it's like a point, you know, it's an $8 strike and the asset's at 9. Don't buy the $9 strike, you know, which is normal. That's normally how most of us do it. We buy like one at the money or at the money. What you can do instead is buy the $8 or $7 strike, because now you're going to be in the money and you'll have intrinsic value. So those pullbacks won't completely destroy the contract. It'll behave more like a normal. So like on those super cheap ones, a lot of times I'll just buy in the money because like I don't want to buy just tons and tons and tons of those like, you know, $5, $10 ones. I'm like, just get the decent normal price ones at like $50, 80, $1, you know, $100 to X, Y, Z. So buying in the money, a few strikes can help avoid that, because really what's happening on those contracts is that you only have extrinsic value and it's just burning super quick because of the probabilities. I also kind of like to, when I'm in a position, I'll buy multiple strikes. Like I might buy some in the money, at the money, and then some far out the money. So in trading options, traders can use quantitative analysis to evaluate the probability of different outcomes and adjust their trading strategies accordingly. They may also use hedging strategies such as buying or selling options to mitigate risk. So that's another option. I don't really do that anymore, but you could always hedge. You know, you can take straddles or strangles against your position, especially if you're like in a long play. So perfect example, like gold. I cut my swing, I think yesterday or last trading session. But what I could have also did, I could have just sold puts. I could have sold puts all the way down from yesterday, from Friday session till today, and then bought it up, you know, hedged it, or kind of like they call those calendar spreads too. But for me, I just prefer usually to get in and out. It's like easier for me to calculate everything. But it's just understanding that like you want to be a position where you're taking risk off the table. People never do that. People just get in these trades and they just let them go forever. And it's kind of hard to explain to people. Like the whole concept is we're trying to take money out the money market, not leave it in. So like if I'm in a swing, especially if I have multiple, I'm trying to figure out a way, you know, to pay myself. I'm trying to, if I got, you know, 2 months on a swing and it's going. On the way there, I'm either going to adjust my stop. Like, let's say I bought, you know, at $1. I'm always going to say $1 because it's easy to calculate. So $100. If it jumps up, you know, perfect example, like gold jumped up the first time we got it like 300%. My natural reaction is to sell a portion of it or sell more of it so I can eliminate that risk, because I already realized the gain that I wanted, if that makes sense. And then like the way I look at it, I can always get back in. So I'll usually start selling portions and then just repositioning. I know someone like FICO, he'll roll his contracts because when you roll them, you also can pay yourself. I'm just not an expert on rolling, so I usually just sell. But in general, it's like locking in money. Like I don't want to sit in a trade and it's way up here and then watch it draw all the way down here and just leave that money on the table. Because realistically, if I know price is going to come up here like this in a line, right? We're assuming price moves in a 45-degree. I know it's going to have pullbacks along the way. So as I'm going, I'm looking to adjust risk. So if I'm at $1 here and I'm up 150 here, I'm either going to take some off the table or I'm going to raise my stop loss, either or. But in general, I'm always moving my positions. I'm managing each of them separately. So if I have 10, I'd probably be selling more than half here. If I have faith in the trade and we pull back, I could just add to my position, which I do a lot, especially in scalping. If I see a trending day, a lot of times I'm buying, I'm selling most of my position, coming down, buying, selling. The biggest mistake people make, especially in this market, is people just try and hold their whole position through a trend. And in this market, the retracements have been super, super high reaching. So like you'll get killed because you'll be especially short and that shit will spike up and you think that your trade is going to fail. So you get out and you just lost 50%. I've definitely done that before. I'm pretty sure everybody's done that. So you lose 50% only for it to go back even further. That's why it's good to kind of manage your positions. In trading stocks, stock traders may use fundamental analysis. This is just for like trading stocks. Diversification, investing in multiple companies, blah. That's just stocks, but we're options. So risk assessment techniques. Risk assessment is a critical component of effective risk management in trading. There are various techniques that traders use to identify and analyze risk. Here are common assessment techniques in trading. This is kind of going to go on probability. So obviously technical analysis. We're using charts and other technical indicators to analyze the market trends and identify potential opportunities. It can also be used to identify potential risks such as price trends, volatility spikes, or trading patterns that could indicate a potential reversal. At the end, I'm going to go more into the risk management with technicals. So don't worry, I'm going to do a full chart section on that. Fundamental analysis. This involves analyzing the financial health, performance of companies. This can kind of work, I guess, for earnings, even though I'm not a big fan of earnings fundamentally because they don't have to fundamentally make sense. It can also be used to assess macroeconomic factors such as interest rates or geopolitical events that can impact trading. So I guess this kind of does make sense like for gold. Fundamentally, like I knew the basis of like why gold would be good because the dollar was getting weaker when I was charting it. Our current economic environment, these are just basic fundamentals. And this kind of goes with hedging. Fundamentally, we know on FOMC days, SPX is going to go up and down nonstop. So a basic fundamental strategy, which a lot of people do, is a lot of people will on FOMC days buy calls on the VIX or UVIX because they know at any time the VIX is going to spike very easily. So quantitative analysis, this involves stats using math models to evaluate market data and assess risk. This includes techniques such as Monte Carlo simulation or regression analysis to estimate the probability of different outcomes. Way more advanced than any of us need to be to trade, in my opinion. So each risk assessment technique has its strengths and weaknesses and can be used to identify and analyze different types of risk. Here are some examples of how each technique can be applied in trading. So technical analysis can be used to identify potential risks to trends. Traders can use technical indicators such as moving averages, Bollinger Bands to identify key levels of support and resistance. So that's kind of like, if you notice, I'll sometimes have that little green line, that's called a trail stop indicator. It's showing me where my stop should be triggering. It's one of my favorite ones to enter when I'm in a trending. These things can help them set stop. These can help set stop loss orders or adjust their trading strategies. So yeah, I know some people do use moving averages as, for that. I'm not really a fan of MAs, even though I know they're not using it for a trend. I just don't like to see them. So I do like the trail stop indicator though. Fundamental analysis can be used to identify risks related to the financial health and performance of companies and the underlying assets. So like I said, this is more earnings. Traders can evaluate factors such as earnings reports, balance sheets, or industry trends to assess the potential impact of different risks. My trail stop is called ATR trail stop. Quantitative analysis can be used to assess the probability of different outcomes and evaluate the potential impact of different risks. Traders can use techniques such as, this is just a repeat. Risk mitigation. Effective risk mitigation strategies can help traders minimize their potential losses and protect their trading capital. Here are some common strategies for mitigating risk in trading. Diversification. I'm not really a big fan of diversification, but I do see it like if I'm in a swing, it kind of, works. That's like the only time. That's like in general, if I'm swinging and I have more than one position, it's the only time I'm diversified. So like if I'm swinging XLK, Microsoft, Apple, NVIDIA, I'm not going to swing 2 XLK stocks. I would probably swing something to XLK. And if I want to technically have more of my port exposed, I might swing something from like XLP, like Kroger or something like that. Or maybe XLI, CAT. I would rather have multiple positions in each sector. I don't want to have I see a lot of people do that where they'll have Apple, Microsoft, Facebook. Like to me in my head, I'm just like, what's the point? You could just swing the SPY at that point. I was just trying to pick the strongest of that sector. In general, though, I'm always like trying to reduce my positions. I feel like for me, and I feel like for most people, that's going to work best. It's really hard to manage multiple positions. I think that's where most traders go wrong. They just get into too many positions. Diversification involves spreading your trading capital across multiple assets or markets to reduce the impact of any single trade or market event. Another thing you guys can do, have separate accounts. So like I remember in the beginning, I would always get thrown off because I would be in a swing trade. And then I will, if we're calling out stuff because there's a lot of you guys and there's a lot of different trade ideas, but like, you don't have to take all our trades. I try and in general, like today, True had MU. So I was just luck that I actually had that on my list too, MU and the chips. But in general, a lot of times I'll try and like make my list similar to his or vice versa, because that way y'all don't get like overwhelmed. Because I know like when people put out like 20 different plays, it makes y'all think y'all got to get in everything, which you really don't. You only need one trade to work. By diversifying your portfolio, you can reduce exposure to any particular risk and potentially increase your overall results. So, and this is why I like, but also dislike diversification, because, hold on real quick. Truehead got kicked. Like I said, this is why I like and then dislike diversification, because think of it like this. If you're in, Apple, Microsoft, Google, Facebook, Tesla, like all 10, but some of them are up on the day 2%, but then some are down 1% and up 3%, up 4%, you kind of just even out. So like, that's why I tend to avoid that. And I'm just more patient, and I try and wait for the strongest, potential setup. I don't like to be just in a mixed basket. So yeah, because if you hold all 5 positions, you're gonna wake up and 2 are up, 1 is down. You're trying to chart each and every single one. You're not knowing when to get out of some. Some are pulling back, but you're confusing the TTO for reversal because your adrenaline's pumping, because you see all this red, it's just not good. So in general, I avoid that situation. But I have one of my ports is for day trading, scalping, and the other is specifically for swinging. So that helps a lot because when I wake up, I don't see any red. When you wake up and you're already red, just something with that red is going to do something to your brain. So a stop loss order is a preset order to sell security when it reaches a certain price level. Stop loss orders can help limit potential losses and prevent emotional trading decisions. Traders can set stop loss orders at a predetermined level based on their risk tolerance and trading strategy. So is, you know, the bread and butter of what I do. I set a stop, and, you know, and I'll, like I said, 30% for me is my stop loss. I know some people have tighter, some people have looser. For me, I like 30 is like pretty good, but a lot of times I don't realize 30 because my chart will stop me out sooner. Another thing too that's gonna hurt you is if your stops are too tight, which, you know, we'll talk about later. Having too tight of stops can kind of trigger you also. Position sizing. This is the most important thing. Position sizing involves determining the appropriate size for each trade based on your trading capital and risk tolerance. By limiting the size of each trade, you can minimize the potential losses and protect trading capital. So this one I'm big on, especially for you guys as you're still, a lot of you guys are learning and getting confident. You guys need to focus on consistent sizing, because I know what a lot of people do. They'll be like, ooh, I like this trade. I'm going to go in, you know, with $1,000 port, I'm gonna go in 200 on this trade. But this trade I really like, I'm gonna go 4. Oh, this trade I don't like, I'm gonna go 50. And then you start taking different size losses on all of them. You take a $400 trade, you know, with like a 20% loss, you just lost 120. Then you take that $100 trade and you hit, you know, 100%. But now you've only made 100 and you've already lost that 120. Then you take another $200 trade with that similar 30%, and now you've lost like $80. So now you're down like over $100 on the day because you just sized inconsistently. And then you take, you know, 2 more trades, you know, $50, and you hit 100%, and you still end up down because you had more winners, but you size wrong. So that's why I try and get people to learn to just, size consistently. Whatever your trick, because it's hard to track your numbers if you're not. So if you have $1,000 port, I always tell people use like 10%. So if you're just using 10%, you'll know out of every 10 trades. It's like a lot easier. You can do 10% with a 30% stop. Make it really standard. Because if you're just going, I always tell people, if you're just going 10% out of 10 trades and you keep a decent win rate, and you use a 1 to 3, you're going to kind of start to be profitable by default, as opposed to this random up and down. So if you think about it, you 10% with a 50-50 win ratio, 5 winners, you're making positive 50%. 5 losers, you're losing 50% of that port. So you're break even. But if you do that same scenario with like a 0.30 stop, now you're profitable. It's the exact same situation. It's just that you stopped yourself out at 0.30. So instead of losing, you know, 50% of the port, you only lost like 10% with those 5 losers. 10 to, I think, like 1.2%. So, or 12%. So that's why I tell people, learn to use a stop. Yep. Yeah, most people, it's just they're not using stops. So each risk mitigation strategy has its strength and weaknesses and can be used in different situations. Here are some examples how each strategy can be applied in trading. Diversification, like we said, that's to reduce risk. You know, it is good for if we're swinging multiple positions of different sectors. But like I said, the downside of diversification is you're also going to reduce profit. So if one runs like crazy, you'll get that, but the other one's not. You're kind of, you know, that's why I prefer to just focus and one trade at a time type of person. Like gold, the whole time I was swinging gold, that's the only thing I swung. I was day trading other stuff, but I literally was only on gold. Diversification can be used to reduce the impact of any single trade or market event. Traders can diversify their portfolios by trading different asset classes, such as stocks, bonds, or commodities, or day trading in different markets. So another option you guys could do is, if you're going to hop in a swing on something like, gold or whatever sector, realistically, you could just hop in some like deeper in the money contracts in like a super safe, very obvious play where it's obvious you're gonna make a low return, but it's still gonna make you money while your money's sitting there. That's another strategy. Or you could even hop in commons. Some people I see, they'll do that. They'll just wait for shit to get low and they'll put a lot of their balance in commons and let it sit, just so that most of their money is still working. Yeah, once I'm in profit, I'll tend to trail it. But yeah, I know a lot of people, that's what they do. They just buy commons and, on their larger port and let it sit. Or you could buy like, sometimes bonds. Like I remember Mr. Resume, he used to trade the bond options a lot. Stop loss orders can be used to limit potential losses and prevent emotional trading decisions. Stop loss orders can be used to limit potential losses and prevent emotional trading decisions. Stop loss orders can be used to prevent losses and limit emotional trading decisions. I think most of y'all need this stop losses. Once you've been trading a while, it's easy, I think, to stop yourself out. But especially with new traders, so many times people will hit me up and they'll be like, hey, bro, should I get out? And I'll be like, oh, what are you in? They'll be like, oh, I'm in Dell. I'm down 80%. Bruh, like you're down 80. What are you talking to me for? You should have been out of that trade. You make yourself, if you just make it a habit of having that stop on your account, but even if you don't, of having a certain level where trades shouldn't go to, it's going to help. But most people will just put like thousands of dollars in a trade and watch it wither to nothing, which is insane. That's hopium. That's not trading. That's how people will turn ports that are like, 5 figures into 4 and 3 in like 2 days, which I hear all the time. People are like, oh, I had, 10K and now I'm at 200. It's because you're not using stops and you're hoping. Most people are just trying to get rich instead of consistent. And that's why they don't. And you think of this like just a journey. Yep. This is a journey to get consistent. Yeah. AMC, the hopium. If you can't port went to dust. Yeah, if you can't consistently achieve results with your trading, why are you not using stop losses? You have to ask yourself that. Like a lot of it's just mental. A lot of people, they just don't like mentally. Like if you don't have a system for mentally taking money out of the market, why are you risking so much? So like most people, I try to tell them, like in general, your size should just be smaller. I don't average down. I'm not a fan of that. Because one of my favorite sayings is there's nothing wrong with averaging down, but I think, what do you say? What do you call someone who averages down on losers or something like that? Or if you average down enough on losing trades, eventually you're going to be the loser. Like I rather realize the loss than average down. I know there are some people who are really good with averaging down, but I think in general, you're going to do much better just cutting the loss quick. Because for me, I can, like I said, I'll have a 30% stop, but let's say I'm in a position and I can tell it's going to fail. I'd rather just stop out at break even than sit there through that drawdown. So I'm always thinking that like I can cut it at break even or minus 1% to where that loss is nothing, as opposed to going in, realizing 30%. So it's always about like your realized and unrealized. Like I did miss out on realizing the gain, but I also missed out on realizing that loss. Versus if I hold and then average down, I've already realized the loss and now I'm potentially realizing more losses to get back even, if that makes sense. So I avoid that. Position sizing can be used to limit the size of each trade and protect trading capitals. Traders can determine their position size based on their trading strategy, risk tolerance, and market conditions. So this is important. Today is the perfect example. This was a day to not really use heavy size, to not go crazy, to chill, because this is a Monday. Monday sets the initial balance of the week, and it was a slow day. There was like nothing high probability. So in general, as we're trading using consistent size, when there's days that are less probable, it's very wise to use less size than normal. So if you're using, I don't know, whatever size you guys are using, 1,000 a trade, maybe consider going to 500, or maybe consider not trading. The main thing that people get wrong, they just don't understand, especially new traders, when to trade and when not to. And that kind of claps them. Just because the market is open all the time doesn't mean you're always taking a trade. That's what we're trying to show y'all. The first 30 minutes, the market is going to usually move up or down. The next hour or so is going to be the fade. So if we push up the first 30, you have a very high probability that hour is going to be a fade down because it's a lot of profit taken. Same with if we push down. Now, if we continue, that's going to be an up day continuation, or if we continue, it's going to be a down day continuation, which is why it's important to have a daily chart somewhere while you're looking at each of these trades. But the main thing is limiting and dividing your day. So, after that, you have the after lunch reversal, which is why we pause, because at 9, a lot of times the volatility dies. I think this time at 9, SPY was slowly climbing up. No, it chopped till after 9. So after 9, 10 o'clock PST, 1 o'clock Eastern, the market usually tends to reverse. So if it's coming down, there's a high probability it's going to reverse up. If it's going up, high probability it's going to reverse down. So I'm always looking for that reversal after lunch. Understanding that after lunch price reverses a lot, or it'll resume its trend, it's going to help you a lot too. Best practices in risk management. Effective risk management requires discipline and adherence to practices. Here are some practices for effective risk management in trading. Traders should establish trading goals and objectives, including profit targets and risk management parameters. By setting goals, traders can stay focused and disciplined in their approach to trading. So I like this one. This has to do with, obviously, consistency. A thing I would warn about, though, is some people, I think, focus too much on being consistent, and that could hurt them too. So, like, perfect example, I saw a guy, he had like 30 days of just consistent green days. And then on Friday, he took a loss that wiped out his whole month. If you have done 30 days of winning trades and days, not just trades, but days, so there are multiple trades, and he was making decent money, for you to wipe it out in one day shows it's not that you didn't know what you were doing because you did it for 30, but that you got emotional and you attached too much to having that winning day. So that's why I don't make such a big deal out of having a winning day, because I know there's days that I might not win, or might be break even, or that I just shouldn't trade. But when you're like so obsessed with like, I got to be green every single day, it can make you emotionally attached to that too much, to where you're gonna fight. So you have to you have to learn how to lose in this game. There's gonna be times where you just lose. Like even me, sometimes I can like counter a loss, but other times I know if I'm doing too much. If I hopped in a trade, I took a loss, then I tried to counter it, and I took a loss, I need to chill. As opposed to like, I took a loss, let me fight someone else. Now you're down more. That's where the revenge trading comes in. Because now you're not trading the market, you're kind of just trading to get back, but you can't pull out of the market what's not there. That's what we're trying to get people to understand. Like, people just focus so much on like trying to force the market instead of just letting the market take. Like, think of it like this: the market's a river, and when you're doing that, it's like you're swimming against the current uphill. So think about it, how long would it take you swimming against the current to get where you're going, versus me just waiting and then just hopping in and floating or drifting down? on my back. You literally just like float downstream. That's how the market is. There's days where it's gonna be, that's why I say like risk on, risk off. Like there's days where it's very obvious and easy to make money, but people spend so much time forcing themselves on the bad days that when it's an easy day, they wear themselves out. Establish risk tolerance. Traders should establish their risk tolerance based on their trading goals, trading experience, and financial situation. By understanding their risk tolerance, traders can make informed decisions about their trading strategies and risk management. So this just means like how much risk you can take on, position size wise and percentage wise. Some people are going to have more tolerance because they've been exposed to risk. The easiest way to tell if you're taking on too much is if you're taking that loss and you start to get emotional versus like when you enter position is now and you don't feel any type of way. So if you're taking those trades that you're still feeling hella like nervous and jumping out, you probably need to size down. So maintaining trading discipline. Traders should maintain discipline in their trading approach, following their trading plan and risk management parameters consistently. This can help prevent impulsive trading decisions and emotional reactions to market events. I had it on my old chart, but I don't know what happened. But like I put like avoiding emotional irrational behavior. And that's going to be moving stops. That's going to be countering a losing trade. That's going to be holding a loser and trying to keep averaging down, trying to find a bottom. Those are all emotional because your trade should be a part of your plan. You should have a trading plan. And that trade is just, think of your trade as like a move that was in your plan. So if you're not taking a move from your playbook, you're not following it. If you were going to war, you're going to have a battle plan. You're not just going to be randomly out shooting like it's Call of Duty in real life. You have a mission plan, mission objectives. That's your trade plan. That's also how you should treat your trading too. Like think of the market. It's like an ATM. So you want to go in, get the money and get out. That's why you see us like when we're done, we're like, all right, cool. Because most people want to do that, but instead they treat the market like a casino. Oh shit, I hit today. Then they sit there and they're feeling good. And I'm like, well, let me just throw money at that. And when you just throw money at that, they just ate a third of your profit, a half of your profit. So now you're like, oh shit, let me come back. Now you throw more money, now you're break even. So now you're frustrated and now you're like, I got to get that money back. And that's where you start to blow up. Ask me how I know. I've done it many a times. So you did it enough times, you start to develop discipline where you're like, nope, I'm good. You want to think of it like when the market is hot and when it's easy is when you want to take risk on, because this shit is made to take your money. Like that's what it's made for, realistically. Like the market is made to take the money from the dumb people. Here's some examples of how traders can apply these best practices to their own trading strategies. Setting clear goals can help traders stay focused on their long-term objectives and avoid getting distracted by short-term market fluctuations. So you could set a goal, to consistently use stops every day, or to consistently keep losses small, or to like, hey, I'm going to consistently, have quote unquote winning days. But when I do have a losing day, I'm going to be fine with it losing at X amount of dollars. So that's the easiest way, like have a set amount of loss. That way, when you do have a losing day, you're not going to get over rational. I think for me, that's the number one way. I'm always in my head like, okay, this is the maximum I can lose in a day. But like I said, it's been so long since I've had one of those days. But think of it, I know some people, they struggle with that and think that it's impossible to defeat. I don't know if anybody in here, does anybody still struggle with like emotional or revenge trading and feel like it's hard to overcome? Perfect. So the number one way that like helped me overcome that, well, that's good, Tiki, you don't. Some people do, some people don't. The number one way, okay, so a lot of you guys do. So it's going to depend on how long you've been trading. The number one way to help that is to think about it logically. I remember when I used to struggle with that, one day I had to tell myself, like, as hard as trading is, I taught myself trading. Like I taught myself to chart. I taught myself, yeah, get it back in blood. Think I'm bloody your ass. There you go. That's good. So like, you have to think of it logically. If you taught yourself to chart, to trade, to set up your broker, all that shit, even though you have help from like us and all these people, you technically do this shit on your own. Realistically, you take the trades. You can teach yourself to control emotions. It's the same thing. Once you look at emotions as like something that's not arbitrary, but as something that is a part of your trading, and accept your emotions and understand and focus on changing your emotions or how you react to your emotions, that's going to help you. So Celestine, that's why you should have, which we'll talk about after. You might remind me to talk about that after. Establishing risk tolerance can help traders make informed decisions about position sizing, stop loss levels, and other risk management. Maintaining trading discipline can help avoid impulsive trading decisions based on emotions or market noise. This one is big. When I started, I definitely had like zero discipline. The easiest way to build your discipline is to start giving yourself rules and punishments for when you don't follow the rules. So like one of mine, I will always wake up late for the market and try and start trading. And I saw over time, like, yo, I'm losing a lot of money because I'm just hopping into stuff without really charting and just trying to catch a play. So what I started doing was tell myself, hey, on days that I wake up, if I wake up and the market is open and I didn't get a chance to look at pre, I'm just not going to trade. So that started motivating me. Like, I have to sleep earlier because I have to look at pre. Because if not, I can't trade. Exactly. Stay loyal to your rules. But if you don't give yourself rules, it's going to be hard. You have to start building your discipline one step at a time. Yeah, pre is important, especially in this market, because shit will change. Like what I looked at last night, which I'm glad I didn't drop a list last night. That shit looked totally different in the morning. Common mistakes to avoid in risk management trading. Effective risk management requires not only following best practices, but also avoiding common mistakes. Here are some of the mistakes that traders often make in risk management. Oh yeah, no, the bedtime rule is crucial, especially for people like me who are on the West Coast. Ignoring risk. Traders may underestimate or ignore the risk associated with their trading strategies, leading to significant loss. So this is just, in general, I think it's more of a guy thing, especially when you're new. Like we just like, especially when I was new, I didn't even understand risk. So I was just full porting everything, which I see a lot of new people still do. And like, yeah, you can build up fast, but you also lose fast. So especially with new people, like when they're growing too fast, I'm always trying to tell them like, hey, that's good, but you need to slow down because I know you're using way too much of your port. Like you shouldn't really be that much already. Because as a newer person, you're just not skilled enough. Now, someone advanced, like me, if you give me a small port, of course I'm a full porter because it's not money significant and I know how to counter it. But as a newer person, you're just learning. You really don't want to do that. You want to focus on that risk management until you build your edge. It's all going to be about edge too. If you don't have an edge yet in the market, which most newer people don't, you really have to think about, if you don't have an edge, why are you so thirsty to be in the market? If you don't have an edge, there's sharks in the water. The sharks in the water, you ain't got a boat. You ain't got a boat. You swimming, you got a floaty. I'm on a yacht. You gonna get eaten. I got the yacht with a chopper. Think of it like that. Failing to plan for different scenarios. Traders may not have contingency plans in place for different market scenarios, such as sudden market moves or unexpected news events. So this one is easy, y'all. Stop trading in front of news. I mean, I'm glad most people get it, but like every once in a while there'll be somebody here and like we'll be on FOMC and they'll be like, yep, I'm voted on puts or calls. And I'm just like, what the fuck are you doing? I feel like that's rare here now because like we talk about it so much, but especially before I knew about all this data, only one I knew about was FOMC. we would always be in stuff and like, whoa, what happened to the market? Even like maybe last year, I think one hit me. It was a random one though. It's like NFP or something like that. It is your job as a trader to know that. So you can't, and I remember like it was actually one of my trading friends. I'm like, damn, that shit came out of nowhere. And they were like, it didn't come out of nowhere. It's listed. It happens, every Friday. That's your fault. You have to have like the utmost highest level of accountability for yourself. That's why people would think I'm a dick sometimes, because I'll be like, oh, well, like that happened to you. But it's because I hold myself accountable. If you can't hold yourself accountable to those standards, you're never going to be successful. You're blaming. Yeah, if you're blaming, oh, the market did this. That's another thing. People always be like, oh, the market did this, or your play did this. Like, motherfucker, you took the trade. The market didn't take the trade. You took it. No one can make you lose money. Even me, I took it even recent. Like I'll hear something. Yep. I'll hear something. And then I'll be like, every blue moon, FOMO in too. But obviously if there's something where I didn't chart it, or I don't know, I'm super light. When I lose money, if I lose money in a play like that, I'll be like, damn, this motherfucker made me, nope. I have to instantly address that thought. Why was I even listening to a random person because something looked good? That was me. So accepting full responsibility is going to really help with your trading. But most people are afraid to accept that. Overtrading. Ding, 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 ding. Traders may take on too many trades, leading to an increased exposure to market risk and potentially reducing the effectiveness of risk management techniques. The easiest way to prevent overtrading, give yourself a time limit. First 1 to 2 hours of the day, especially the first 30 to an hour, because that's when the volatility is in the market. Anything after, you need to be looking for a reversal. Most people, like I said, they get that lottery slot machine effect and just keep trading, and that's how you screw yourself. In general, usually, like, I just don't take too many trades. Like, if it's like a trade where I get in and get out instantly, like if I take two, I don't really count those, but like of the trades I'm in, where they're either working or failing for time, those are trades. And I'm like, all right, that's it. Like, you shouldn't really be taking more than like 5 trades a day. I know some people would take like 10, 20. It's like, what are you doing? Now, if that's just your style, you're like a high volume scalper and you're successful, don't let me, because at one point I was like that. I would take like 10 trades, but it was my style, but that's not really my style. I'm more, even if they're scalps, I'm trying to get in, take the money out, leave. Clock in, go to the screen, find my setup, execute my buy, execute my sell, take the money out, put it in my account, log off. Because once it's in my account, it's safe. It's now mine forever, especially if I transfer it. They can't take it from me. But what people do, hit big, sell, hit big, sell. Oh, it comes back, loss. Okay, let me sell again. Oh, it reverses. Oh, it's a breakout. This chop right here was a low volatility after the first hour. And you just erased all that work because you're not thinking, like, you have to think in the mindset of like, we're coming to this machine to take the money out, not sit all day. We're taking the money out. So like after our first few trades, that's why we're so quiet or we're chilling, because we're kind of, you'll hear us after because we're looking for the reversal. But if there's no reversal, or if we're inside, we're chilling. Here are some ways that traders can avoid these mistakes and improve their risk management practices. Conduct regular risk assessments. So this is just journaling, to be honest. Traders should regularly, 3 max. Traders should regularly assess the risk associated with their trading strategies and adjust their risk management techniques accordingly. So this means constantly looking at your risk management plan. Hey, am I achieving said R's? Am I following? Background music's playing? How's their background music playing? Hold on real quick.
Background music.
Huh?
I said, I don't hear no background music.
Right, yeah, I'm like, what? I don't got no background music. Results trolling.
Tripping.
He off a perk or something. um, so yeah, like this is understanding journaling, or understanding R's. I would definitely look at like R factor, which I'll talk about a little after, but I think the R system is really gonna help you guys. Developing contingency plans. So this is like, hey, I have a plan. Like when I'm over trading, which is very, very rare, I know like to get my ass up, walk away from the screen. Traders should have contingency plans in place for different market scenarios, stop losses, automatically hedging, or alternate trading strategies. So like that would be like more advanced strategies. Like I know some people use or have used the martingale strategy, which is a very complex system, but there's other ways to manage risk. But like for me, I just use stops. I'm not a big fan of hedging. Avoiding over trading, once again, that's gonna be, especially in new traders, that's be the number one, because what happens, you're scared to take a trade, then you get better and you start making money trading. You start associating trading with making money. So since you associate it with it, you naturally want to trade more because you're making more money. But the problem is trading doesn't make you money. Good trading makes you money. But as a new trader, you don't realize that. You just think it's trading. But it's good trading that makes you money. Anything else is just luck. And it's a while, it takes you a while to realize that, like, hey, a lot of these trades I won were just lucks or call outs or I heard or I got a tip, versus like, this was a plan, this was the setup. I knew how much I was making, I knew how much I was risking. And if I follow this plan, I'll be successful. Most people just don't think like that. They just do a lot of random shit and they dabble. And if you dabble, you're going to get dabble results. So traders should stick to their plan, avoid taking too many trades, which is why when y'all be calling out stuff, I just be quiet. Y'all be like, oh, look at this, look at this. I'm like, man, fuck that trade. Because even that is enough to tempt. Like the market is literally, for anybody, no matter who you are, that shit, the market is literally, it's an enticing, especially when the patterns are easy. Like for us, like I've been looking at these patterns, they're so, some of them are so easy. Like I took a reversal of the air, but I was like, how'd you take it? But like, that's just to realize the longer you stare at the charts, the better your pattern recognition is going to get, where you're going to see an obvious reversal. But if I don't have a plan, like I don't have a true profit area, I just don't know the stock, I'm just not going to take it, because the markets are always going to be here to lure and entice you. They should also consider using position sizing techniques to limit their exposure to market risk. Yeah, for real. Y'all be telling me, oh, check this out, check this out. I'm like, no. Or sometimes I just ignore it. Like, I ain't even gonna read that, because there's always, and that's what I'm trying to tell people, like, right now, while we're talking, there's something that like just had a FOMC, last week's FOMC 100-point run. It's happening right now. Like, there's always something running up or down. So to think like I'm missing out, it's like a mental sickness in your head, because you just can't catch them all anyways. I can only catch what I plan. In conclusion, effective risk management techniques are essential for successful trading, and they require comprehensive understanding of the different types of risk, the risk management process, the risk assessment techniques, and the risk mitigation strategies. Traders can improve their risk management by following the best practices such as goal setting, risk tolerance, maintaining your discipline. So like I said, that's going to be, hey, if I'm not up in time, I'm not trading. If I'm not in sleep in time, I can't look at pre, I'm not trading. If I'm not walking away from the screen at this time, like you have to give yourself punishments to make it real. Additionally, they should avoid common mistakes such as ignoring risk or failing to plan for different scenarios and overtrading. And that's another thing, planning for different. So I'm always like, what if this trade fails? Which is why you'll see a lot of trades where I'm getting out quicker, because I'm always thinking like it can go this way, or it can reverse, or it could chop. If it chops, I'm just going to get out. Or if it reverses, I'm going to get out. As you move forward in your trading journey, remember to prioritize risk management and make it a central part of your trading strategy. With the right tools, techniques, and mindsets, you can potentially improve your trading performance and achieve your trading goals. So just as you see, like our discipline, you guys can get there too. It's just a work in progress. Most people just need to work on their discipline. Thank you for your attention. I hope this presentation has been helpful and informative. I will now answer questions. Boom. All right, y'all. Whatever questions y'all got, y'all can throw them at me. Yeah, y'all like that? I made the background myself, like all matrix pictures and shit like that. Okay, so rolling contracts. Rolling a contract is, let's say, like if I were to buy SPX March 15th calls, 0 days, and we start coming up, what I could do is roll it to the next day. And what it will do is basically it's going to sell my contract and buy another, and it's going to collect the capital, and it's going to put me into a next day contract. But you can also roll them up or down. Like when you're going up, a lot of people will roll them up as they're going because it's going to collect profit. So that's rolling your contracts. Or like if you were in puts, you can just keep rolling them. Like, hey, I only bought weeklies, but I think it's going to continue. Like I said, I'm not a big roller because I just sell them, but it's kind of the same thing, selling and buying back in. Just a easier way to ride the trend. Oh yeah, let me answer the last 10 minutes. Dre's been harassing me for months on that. Oh man. All right. I'm gonna answer that. When do you add to a starter at what point? Perfect. So like let me give you gold is probably the best example. So the gold trade, like right here, I'm technically, I got in and out of these, but let's say, I'll just go to the first. When I first got into gold was like down here. I have been watching it for a while. So then I just kept refining my entries because I knew we were going to break out. And for me, keep in mind, I do a lot of ICT. So I know if I'm at a bottom, it's just understanding how structure moves. Remember, buy side, sell side of the curve. Price is going to come to a bottom and it's going to start the flattening process and the accumulation. When I start seeing buys, I know if price hits the bottom, just because it made a lower low doesn't mean I instantly get in, because it's so rare that price just hits a bottom and then just reverses like that. In a perfect world does that, but I know it needs to accumulate. So I'm watching for them to take buys, which I noticed were these wicks, buys. Where were they at? At key levels, order block. Buy, right here, buys. So once I saw them come back, I had already started entering starter positions. And then once we started to break up and we're breaking structure back up, I know we're likely to take out this high now. So now I know I have a big enough trade from these two starter positions to add. So that's where I'll start to add if I want to swing. Sometimes I'll just add in sections, and other times I'll just, once I know the trade is working, I'll add fully. So like this one, I remember I just like right around here, I think I just added fully. And I think after the stop hunt, I added like a small position on the way up. You could also do the opposite. You could start a position and then you can start selling. So you can start taking partials out. So like if I'm scalping, I'm the opposite. Usually I'll enter a position and I'll be selling them. But if it's a swing and I have time, I can kind of add in slowly. Just then, it depends on the market, to be honest. All right. Getting disciplined by disciplining yourself is, yep, facts. So let me do last 10 minutes. Last 10 minutes. So like when I say the last 10 minutes, it's because if you look, so we'll look here. Let me actually, I'm gonna go to the 2-man chart. Or actually, we'll go to a 3-man. So we look, this is from 5 to 6. We look at gold futures, the last 5. if we were to look on a smaller time frame, this is obviously a two down, and a two up. If I'm watching the last few minutes, it's going to tell me the structure of what's happening for these reversals that I'm figuring out. So if I see, like here, this is a two down, two up, right? Obviously, right there is where we cross a two up. If I'm watching the last 10 minutes of the candle, I can see what's happening. Hey, we've been consolidating and we're on lows and we're pushing up and we're likely to break out, versus just seeing a break and taking it. Because let's say we were consolidating this whole time, but instead our structure was like this. This is more like a consolidation up, but there's also one called a drive pattern. And I start seeing a sharp down, or even before it, I know that even though we're about to peak it, it's likely to be a false break. So it's going to trigger and fake me out and take me out, because that's a drive pattern. Versus here, I can see this is like bottoms being made and accumulation because of the wicks. I always watch the wicks. When you start seeing these wicks, that tells you there's buyers or sellers. So I understand we had a low, and it looks like this strong break up, especially if I use volume, the volume is supporting this strong move up. So I can tell price is likely to break through and have that true 2-2. Versus you could also do something like this, where it's triggering back and forth. That's why you want to watch the hour. Look at the S&P 500. There was a clean reversal wick entry here from marked midday. But if you watch the 2 minute, it wasn't ready until structure started to confirm it, because technically that was a hour down, and then an hour up. But look, we were almost parallel for these 2 hours between 8 and 9. Because why? If you look at the structure, we still needed to accumulate. So this level, there wasn't anything. So if you watch the 10 minutes, even without watching the full hour, if you just watched going into 9, you would have saw, hey, we pushed up, we aggressively sold down, and now we're coming back up. So now, as we're coming back up, what happens? We fall out of force. That's why you want to watch the 10 minutes. The main PD arrays I like to use are going to be probably breaker blocks and mitigation blocks and order blocks. Just understand that, like, the easiest way to tell what side of the curve you're on is you're going to start to see the opposite PD arrays. So on the way down, you're going to see bearish PD arrays, like right here, a little mitigation block. Didn't fully mitigate it though. Look at this, bearish fair value gap. That's a bearish one. But then on the way up, what we start seeing? Bullish ones. Push up, no displacement, push up, we sell off, we come below. Here's our displacement now. Displacement candle, bullish for value gap. just got created. The creation of the PD arrays is going to help you determine which way price is drawing to. That's the easiest way. To be honest, it's so easy once you really start to get it. Bullish fair value gap, bullish order block. Fair gap, smaller time frame, fair value gap, bullish. These are all bullish. What are we attacking? Buy side liquidity now, because what we took out sell side here. How do you know? Because there's a low that got ran. That's why you'll see me sometimes do that to remind myself. If a low got ran, now I just need to look for my displacement and the creation of bullish arrays. Bullish, bullish, bullish. We even start to get bullish slight breakers. Right here would be almost like a breaker block. Boom, boom. 30 hour. There we go. Another bullish fair value gap. What does it connect to? Bing. And you can refine this entry. This is on the 15th. What is this? London kill zone, but we're parallel. That's why this day wasn't high probability, to be honest. I was kind of like, like, to be honest, if I didn't have this group, I just wouldn't have traded this day. But boom, there's lows ran. What do we create? We come into a fair value gap that's an old bullish one. We start creating more bullish PD arrays. And we're all the way in discount. So always think of that. What do we create? What are we targeting? Like, before you take a trade, am I on the buy side or sell side of the curve? Am I targeting buy side or sell side? Has there been displacement and a shift up or down? And has a bullish PD array been created yet? There hasn't been a bullish PD array created. You shouldn't even really take it. You have to look for displacement. That's part of it. I don't separate. You guys always say 10-minute, 15. All time frames are the same. You have to realize that. So until you get candle down with me and time frame, you're not gonna understand. This 5-minute wick is the same on the minute. It's still an aggressive reach. And it's not even a wick. Then we go to like a 15-second chart. It's all the same. There's like, time frames are kind of like an illusion. It's still price getting bought up. They're lifting the bid and then they pull the offer down. Look at that. Bing, bing, bing. This is still candles. But understand, wicks on higher time frames are order blocks that are getting created, just micro. So displacement happens on all time frames. I just need an aggressive reach, because that aggressive reach is going to give me a hint that price is looking to draw the other direction. These reaches weren't aggressive, as you see. Look, this was kind of aggressive, but like, let's see, this one, look, we reached, but it wasn't super aggressive, and that's why we made a lower low. But when it's aggressive, you know, there's a very low, especially when it's aggressive and there's a PD array created, and you've purged liquidity, there's a very low likelihood of it coming back. How do you handle TTO that's pulling back too crazy? I get out. So a TTO shouldn't pull back too crazy. The easiest way to understand a TTO, uptrend line. So even if you don't know ICT, there was tons of TTOs that happened in this M10. We'll go to M5 and you can really see them. All it is a pullback in the direction of price, and it makes a triangle. TTOs are the easiest thing. What you need to find is a healthier trend. So you need to understand, when you start seeing price and it's pulling back too aggressively, it's probably breaking the trend and it's not a TTO. Now, let's say it's pulling back deep, but I haven't hit a critical level. That's another thing too. If the easiest way to tell if it's a reversal, like here, people thought this was a reversal, a TTO, when it really was the start of a reversal. Easiest way to know, look to my left. I've already started to run buy side. I've already ran these highs. So I should expect price to come down. Here, this isn't a TTO because I ran these lows. So since I ran these lows, I should expect price to come down. And if you look, once again, the volume supported it. But most people just, they don't trade with like a real narrative to their trading. Once you start to have narrative, it makes more sense. Look at this. Volume is mixed. Mixed volume like this equals mixed buying and selling, which equals balanced or fair value. What is fair value? Fair value, equal distribution and accumulation means we're just consolidating. That chop, yeah. If it says sell side, accumulation, and just think of it like they're accumulating positions. How to avoid being faked out with, say, 0 DTE SPY in the morning. It just takes skill, and it depends on if you're talking about the first open or if you're talking about the 15 or the 30. So it's really going to depend on the time frame. And understand too, the market, like, it's really, once you understand the time aspect of it, like, that's why I divide my day. The first 30 is that break, the opening breakout. The 30 after to hour is the fade. The 30 before 15 or whatever is just kind of the setup or chop right before lunch. So I don't even take that. Lunch, I don't trade. After lunch is the reversal. The hour after is continuation. Time and price. But then also understanding that time is where you look for your AMD to happen. That's where you're looking for price to manipulate. We look, Asia was right here, London manipulated, which is why I thought we were bullish, because really the Asian range right here, London was consolidation, but it was also manipulation. So I was expecting NY to expand. That's what happens a lot. Also, another thing that can help you, if you realize you can play strat reversals off of the main kill zones. I do that all the time. So like, let's see, let me just turn on the thing, it'll be easier. London was a 2 down, 2 up. New York was an outside candle. Asia up, up, continuation, outside range expansion. Like I do, because there's gonna be setups on daily, but there's also setups within the session. People don't understand that there's 2 different types of setups. Like, this is the easiest way to play it. Think about it. If you have this axis, you realize, what did New York do? New York made a high. What is this? 2 up, but what happened? It came down. So this is a failed 2 up. It's a failed 2 up continuation into London, Asia, and then what happens with Asia? London breaks it. So now this is a 2 up, 2 down reversal into a 2 down continuation. So you can play 3 pattern setups between each indices. What is Asia? Asia is inside of NY right now, consolidation. If London opens over Asia, that's a 2-1-2. Very easy. Very easy, very simple, straightforward. Yeah, I use it all the time. It's my favorite thing to do. But the best is obviously going to be a 3-day setup because you're going to get more range. But when they're not there, I'll play the sessions because Monday is the start of the week. We're setting the initial balance. Yeah, that's for sessions and indicator. These I draw them, but the one where it's just sessions, it's going to be ICT. Read this one. There you go. I just pasted it. Oh, is Tiffany in here? I forgot to answer her question. She had a good question. I forgot what it was. It was a good question. I don't know if she left. Let me see. Shit. Tiffany. Oh, she's still here. I think I don't know if that's her, but either way, I remember her question. So she said how to get over her fear of 10%. So you really have to understand the narrative. If I'm aiming for up to here, it makes no sense to have a 10% stop. And this, especially when I first started trading futures, because this shit was scarring me. You have to think of your R potential. If we're going in R being your risk to reward, so there's static, I mean, not static, there's risk and reward, but we just call R's. We're going to pretend we're using, this is gold, this is GC, obviously, I use GLD. If I'm aiming for this high, and I'm way down here, realistically, I could have a much wider risk than normal because I'm going to make so much more off this move. Because this is like 40 something point, 44, 45 points on yeah, that's like $45,000 or something. Like gold is crazy the amount it pays. But we're just gonna assume this is we're gonna assume this is ES, it's easier to calculate. If I know I can get 45 points, it makes no sense for me to have such a tight risk of 10% because if I'm wrong, I lose 10, but then I miss out on 45 points. So that 10% position on SPY, 10% of SPY, you got a $200 contract, you just lost 20 and you missed out on a four and a half point run. That's going to easily be like 400%. So you missed out on 800 because you were scared of losing 20 or you were obsessed with only losing 20. So you have to realize you want to have in general a tight stop, but you want to get, the more advanced you get, the more you're going to want to trade for opportunities. So like this is a higher R, higher probability. So you want to have a slightly looser stop or a stop that is realistic. When you're putting your stops in areas that are reactive, it's going to get hit. That's one thing I had to learn the hard way. Like, yeah, it's cool to have the tiniest R. You know, like you can come down here and you could refine it. So like, especially like you guys who saw like when Elise did it with hers, she refined it, but keep in mind, that's like an expert level trader. So you could refine it, order block, run the lows, look at this, max risk reward. But at the same time, let's say you refine it so much that you're like, oh, you know what? I'm going to enter here and my stop is going to be here. And then it gets red. Are you really not going to get in because you lost 1% to miss out on this? A 1 to 134 trade because you're like obsessed with R's. So you have to think like your R's are going to count for realized and unrealized. If you miss this trade, you didn't just miss out. You didn't just lose your 1 R or 0.5 R that you're proud of. You realistically, you lost like 140 R because you had the trade and you entered it and then you lost it. So you have to think of your R as realized and unrealized. I always try to think of it like that. If you're not realizing your R's, it's kind of useless. You have to start realizing your trades. Like people set up all these like, oh, 2230, 212, but if you don't hold it, what's the point? So yeah, that's how you do it. But in general, you need to get, I would recommend 10% is like, in my opinion, kind of too tight. if you're gonna do that, I would either take less contracts and up it, or I would just look for higher probability setups. But I just think a 10% stop for most people is gonna be too tight, especially if you're still learning. There's some people who can do like a, but they're so precise they can do a 5% stop all the time. But it's like, why stress yourself out and do all that when you know you knew down here was going? You could have just had a reasonable stop. You could have just used a swing high or swing low. Or just swing low. Realistically, this person did all that and this guy made more because it's like, oh, there's a low. Here's my high target. This person made a lot more than this guy. Because this guy, even though he had this 100R setup, he didn't realize it. You do that over time, 10 trades, you only realize one of them. This guy is constantly realizing this guy's going to win. He's up like 80R. This guy gets lucky and might hit 100R, but think of how many times he got stopped out. If you get stopped out that many times, you're just not going to hold. So that human element comes in too. Especially, it just doesn't really make sense if you're, you know, you have a high run rate, you can kind of keep adding and, you know, double your position. So. But any more questions, guys? I think that was all of them. Oh, someone put profit targets. I use, you know, hour 30 swing highs, swing lows for my profit targets. Yep, iPhone memo. That's exactly what that was. Always. Yeah, I do. That's what I said. I'm looking at swing highs. So boom, there's a swing high, swing high. Targets are easy in my opinion. I mean, you can use swing highs. You can also use ATR. If you're on a 15er, this shit moves $3 every 15. So, you know, every 15-minute candle is going to give you that. Like on a daily, what I like to do is get in before the range expansion. So if I'm on a day, if I can get in before the manipulation, my target is going to be the pivots, but also I'll have an ATR target. So I'll be like, let's say like this day, if I got in here, I know this is a 2 down, 2 up triggering. If I can get in below, the strat entry is here, but I know below here is buyers. So if I can hold this line and ride it all the way up, once I pass this, I'm just going to look for what the ATR of the day is. So I know the day is 33 on the ATR. This open is here. About 33 points would be like right there because I'm opening inside. Yeah, I scalped gold today. Do I always use pre-market highs and lows for entry targets? Sometimes, it just depends. Like it's usually off the open, but sometimes like if I'm using SPY, I don't really, because I have ES, I just look at ES. So ES is a giant pre-market. Like I don't have to look at SPY pre-market because look, this London showed me this low rand, which showed right here, which is why, remember guys, I was like, I think we might get out of ES. The gap's gonna fill. Remember I said that, I kept saying like the gap. Sure enough, we came right down to this low, which you can see right here too. Look at that, came right. That's why Remy was short. I remember I told him like right here, hey, you should probably get out. He got on in profit, it spiked up. He would have got slightly more, not much more. Oh, actually, we got $1, maybe. I don't know where he sold. 39, 396.22. Not much more, like probably pennies. slightly more, it comes up. But this, you have a very high probability the logical person is going to sell this. It's crazy too, because this was actually a clean entry. I remember right when I sold, clean wick, clean VI. That was a very clean scalp. This is one I would have taken, but it was like right after I sold my position. But that was actually a very clean VI. Because a trade like this, this is what we're looking for. This zone, you could tell, is so reactive that price isn't going to want to come back to it because of the reach being that high. This wick crossed. To refine it further. Price has to paint over this volume imbalance. Well, it doesn't have to, but it's very high probability it's going to paint over a volume imbalance. Go to, let's see, M1. Boom. Right here, when we refine it more, this is technically an implied gap. So if we know this is an implied gap, this is why you can just trade SPY all day. Like half the time just trading SPY. It's just, this is an implied gap. What do? We measure it. Right here. What is this? Consequence encroachment. Boom. Break pass, we don't even hit CE. So we didn't even come to the gap and price already came down. You could have just, technically, you could have tagged your your short position and just used the swing high. Because we didn't even hit use here or consequence encroachment. Because we still came into this implied gap. Then you just target this low. Because you don't know how far it's going to come down. That's a 9, and that's not unreasonable. And that is, I forgot what this line was. I don't know what this line, I think it was a fib level. Oh, that was the money zone. Show you're in the money zone. So this was a major zone, so you could have actually realized that. Because I used that line, been on mine. Boom. 11R. You can trade this shit back and forth. Yerma zone, 2-hour wick. Oh no, this is the daily. This thick line was the daily. So you're 2 down, 2 up, mixed with the Yerma zone. So you could take it all the way to 2 down, 2 up, 13R. But you could have took this one first because this is going to run the lows. So it's safer because once we run the lows, it's logical to expect that price is going to run the lows and then do this and run some of these highs. You might not want to sit through that before running lows again. Am I on another screen? Just this one. Why? Oh, God damn it. My bad, y'all. Hold up. Hold up. Let me switch. I was on the, why does it do that? That's crazy. Let me switch to the screen. There we go. So let me redo that whole thing. Sorry about that. Shit, I hate when I do that. So I was saying, if you look, there was a volume imbalance right here that we created. This fiver created this huge fair value gap, but you can always refine the gaps. Because when you see this reach, because that's where I was talking about how like I told Remy to get out of the trade was because I saw this was a gap fill that was setting up. So even though we came down and he got out, he could have got a little bit more, but I knew that reach was going to take him out. But also when that reach happened is when it showed me like, damn, that reach was a clean entry to re-short. So re-shorting here, we'll refine the zone, which always want to try to do. There's a volume imbalance. We go down to M1. And right here, we can see there is a implied gap. Actually, it's a slight VI. I didn't even notice that. There's a VI within the implied gap too. So you could have refined that. That could be your entry right there. And up here, this is where the implied gap exists. The 50% of this was the consequence encroachment I was talking about, but it didn't even touch it. Didn't even touch it. So since it didn't touch consequence encroachment, your short position could be consequence encroachment. And you could have even used VI for entry. Your target is going to be swing lows. We know price is going to look to take out these swing lows because we just purged recent buy side that was created on the way to macro sell side. Internal buy side, you see the purge. Come down, take the lows. The reason I don't aim for here automatically is because anytime we purge the lows, we're likely to come up, and I don't know how high we're going to come up. So I don't want to sit through that. But as we're coming down, you can take that. First one would have been here to this macro target, which was the Yerman zone on the charts. Which is just a macro area I had. Or the 2 up, 2 down on the day, which was there. I mean, 2 down, 2 up, I'm sorry. But as you're going, there's always entries. That's why I like SPY. This was a 13-1. You could just replay this, to be honest, over and over. M1, look at that. Clean entry, another implied. This is if you want to get crazy with it. Stop could have been that swing. This is really aggressive with stacking. And then look, where's price delivering to? It's delivering to the sell side. What we use to get out, we can technically use to get back in. Since it's delivering there, it's just an inside up, 212 up above a critical level. You just use that swing low. This is how I like to do it. Boom, inside candle, swing low, target these highs. But you know, it's probably, it doesn't have to, but if we're coming this high, there's a very high probability it's not just chop and it's accumulating higher. So you can just hold till exhaustion, which would have been this first black candle right there. Still 2 and 1. Then on the way down, there's another implied right there. Implied gaps are really good because they give you like a lot of entries. I don't know if this one is implied because we're doubled. This one might not be implied, but it could also be kind of like an order block. There's an order block like right here. Yep. It's be kind of like on a small time frame, like a breaker. Ran it up, sold it down, almost ran the highs. See, there's a lot of entries. Yeah, you could scalp like crazy with, especially with futures. Like we look at ES1, literally that's all I had was 2 hour, we hit that level. What the fuck? Oh, this is like on a No, different chart layout. What the hell is this? There we go. This high right here. Midnight open was a huge range that got created. And then there's the order block. I mean, not the order block, fair value gap. Right here, between midnight open and that 2-hour zone, this range got used like 3 times. There's fair value gap right there. Order block. Or you can use swing low. I'm going to use half this. The midnight open, what we do, we sold off. Look, came back. Another implied gap. Implied gap. We shorted. Short below. We use the CE of this fair value gap for safer, because the wick might come into a third time and then back to the 2-hour range. Boom. Or we get in for that swing low right below. There's a lot of trades that got generated. Just a lot. Every time I retrace this, it's gonna be a trade. Look at that order block right there. Bearish order block. Get a short it there. There's a lot of trades that happen on SPY. You didn't even use the wick. You can get crazier with it and use some of these wicks for buys, which I do sometimes if I can see a clean one. Can't find a clean. This one's clean. There we go. I always like to look for one that reaches up. There's my buys. This one was a little too high. But this was perfect. But all right, y'all, I'm about to get out of here. If not, I'll just keep charting. until I feel like sizing up, like I'm pretty consistent on my size. So I don't like now if you are looking for yourself, I would say like if you're trying to size up, say like, hey, I'm gonna be consistent for like 30 days before I size up. That's a good way. If I'm not, size back down. But you want to get to where that size doesn't worry you. That's the easiest way. You could even use the 50%. There's so many ways to trade. Like you could just use this 52 of London's range as a major zone. Halfway below London. Below this major 2. These lows are all reactive. This one's not as clean, but still ran these lows. But I would prefer it ran that low. But boom. Any of these, this could have been a clean entry right here. Yep. All right, y'all. Yeah, I'm out of here. Yep. All right, y'all. Later.